What's up everybody, it's Graham Stephan here and welcome back to the channel. Today, we're diving deep into the world of US investment funds. Whether you're just starting out with a few $100 or you're already a seasoned investor, understanding investment funds is crucial for building long-term wealth. We'll be your guides, breaking down complex financial jargon into easy-to-understand concepts. We'll introduce you to some of the absolute best-performing funds on the market, those hidden gems that can really supercharge your portfolio. But it's not just about picking the right funds, it's also about timing the market. We'll be sharing some of my personal tips and tricks on how to identify the optimal buying and selling opportunities. Remember, timing the market is tricky, but with the right knowledge, you can significantly enhance your returns. So, buckle up, grab your notebooks, and get ready to learn everything you need to know about mastering US investment funds. Let's get started. First up, we're kicking things off with a true titan in the investment world, the Vanguard 500 Index Fund, also known as VOO. This bad boy is like the bedrock of many successful portfolios, and for good reason. The beauty of VOO lies in its simplicity. It's a low-cost index fund that tracks the S&P 500, which is basically a collection of 500 of the largest US companies. Think Apple, Amazon, Google, the heavy hitters. Now you might be thinking, why invest in an index fund instead of picking individual stocks? Well, think of it this way. Picking individual stocks is like trying to time the real estate market in San Francisco or New York City. It's incredibly difficult, even for the pros. With VOO, you're getting instant diversification across hundreds of companies, which spreads your risk and increases your chances of long-term growth. It's like having a team of expert stock pickers working for you, but at a fraction of the cost. Let's talk numbers for a second. The VOO has historically delivered an average annual return of around 10%. Now, past performance isn't always indicative of future results, but it does give you an idea of the potential growth you could see over the long haul. And here's where things get really interesting, the expense ratio. The expense ratio is basically the fee you pay to Vanguard for managing the fund. With VOO, that expense ratio is a minuscule 0.03%. That's insanely low. To put that into perspective, let's say you invest $10,000 in VOO. With an expense ratio of 0.03%, you'd only be paying $3 per year in fees. That's less than a cup of coffee for access to a diversified portfolio of some of the most successful companies in the world. So, if you're looking for a simple, low-cost and effective way to invest in the US stock market, the Vanguard 500 Index Fund is an absolute no-brainer. The VOO isn't just about impressive numbers, it's about building a solid foundation for your financial future. It's about taking advantage of the power of compound growth, where your returns generate even more returns over time. Remember, investing is a marathon, not a sprint. It's about consistently putting money into the market, even when it's uncomfortable or seems scary. And with a fund like VOO, you can ride out those market fluctuations with confidence, knowing you're invested in the long-term growth of the US economy. In the next chapter, we'll be diving into another fantastic investment option, the Fidelity Contra Fund. This fund takes a more active approach to investing, and it might be a great fit for those looking for potentially higher returns. So stick around, hit that subscribe button, and get ready to learn about another powerful tool for your investment arsenal. Alright, moving right along to our next top pick, the Fidelity Contra Fund, or FCNTX. Now, unlike the passive approach of the VEO, the Contra Fund is all about active management. This means that instead of simply tracking an index, FCNTX has a dedicated team of analysts who are constantly researching and picking individual stocks that they believe have the potential to outperform the market. It's like having a team of expert stock pickers working exclusively for you, scouring the market for hidden gems and undervalued companies. Of course, this level of active management does come with a slightly higher price tag, but the potential rewards can be significant. So, what exactly does the Contra Fund invest in? Well, it primarily focuses on large-cap growth stocks, which are essentially shares of well-established companies that are expected to grow at an above-average rate. Think tech giants, innovative healthcare companies, and disruptive consumer brands. These are the companies that are shaping the future, and FCNTX aims to capitalize on their growth potential. Now, it's important to note that because of its active management style, FCNTX tends to be a bit more volatile than a passive index fund like VOO. This means that its value can fluctuate more in the short term. However, for investors with a long-term mindset and a slightly higher risk tolerance, FCNTX has the potential to deliver some serious returns. So how do you know if the Fidelity Contra Fund is the right fit for your investment strategy? Well, it really comes down to your individual goals, risk tolerance, and time horizon. If you're someone who prefers a more hands-off approach and wants to keep things simple and low cost, then the VOO might be a better option. But if you're comfortable with a bit more risk and are looking for the potential for higher returns, then FCNTX could be a valuable addition to your portfolio. Remember, diversification is key. Don't put all your eggs in one basket. Instead, consider building a diversified portfolio that includes a mix of both passive and actively managed funds. In the next chapter, we'll be exploring another exceptional investment option, the T. Rowe Price Blue Chip Growth Fund. This fund has a stellar track record and focuses on investing in well-established blue chip companies. So make sure you stick around to learn more about this powerful investment vehicle. Alright, let's talk about another great fund, the T. Rowe Price Blue Chip Growth Fund. You hear blue chip, you think big established companies, right? You're not wrong. This fund focuses on large-cap U.S. growth stocks. Think companies with a proven track record, but more importantly, companies poised for future growth. Now, before you think, Graham, this sounds like every other growth fund. Hold on. What sets this fund apart is its active management. See, with passively managed funds, you're basically tracking an index. But with active management, you have a team of seasoned professionals actively picking and choosing stocks. They're doing the research, analyzing market trends, trying to beat the market, not just match it. Let's talk numbers, because at the end of the day, that's what we're all interested in, right? The T. Rowe Price Blue Chip Growth Fund has a solid track record. Over the past 10 years, it has delivered an average annual return of around 15%. Now, I know what you're thinking. Graham, that's incredible. And you'd be right, but remember, those are past returns. The market is like a roller coaster. It has its ups and downs. Some years are better than others. But the key here is consistency. This fund has consistently outperformed its benchmark, and that's what you want to see. You want a fund that can weather the storms and still come out ahead. Now let's talk fees. Nobody likes fees, right? But they're a part of investing. The good news is that this fund has a reasonable expense ratio coming in at around 0.67%. That means for every $10,000 you invest, you're paying $67 in fees per year. Not bad, especially considering the active management you're getting. Remember, when you're looking at fund performance, don't just focus on the returns. Look at the risk as well. This fund is considered to have a medium to high risk level. That means it can be volatile, especially in the short term, but over the long term it has the potential to deliver those sweet, sweet returns. Now you might be thinking, Graham, this all sounds great, but is this fund right for me? Well, that's a question only you can answer. But I can help guide you a bit. This fund is a good option for long-term investors who are comfortable with some risk. If you're someone who's saving for retirement, for example, and you have a time horizon of 10, 20, even 30 years, this fund could be a great addition to your portfolio. Remember, the longer your time horizon, the more risk you can afford to take. But if you're closer to retirement, or you need access to your money in the short term, this might not be the best option for you. You don't want to be forced to sell your investments at a loss just because you need the cash. And lastly, remember diversification. You've heard me say it a million times, but I'll say it again. Don't put all your eggs in one basket. No matter how good a fund looks, it's important to diversify your portfolio across different asset classes. So, there you have it, the T. Rowe Price Blue Chip Growth Fund. A solid option for growth-oriented investors. But remember, do your own research, understand the risks, and make sure it aligns with your financial goals. Alright, let's talk about a fund that's been a powerhouse for growth-oriented investors, the American Funds Growth Fund of America, or AGTHX, for those of you keeping score at home. This bad boy has been around since 1973. Talk about experience. And it's got a proven track record of delivering solid returns. What I like about AGTHX is its diversified approach. It invests in both large-cap and mid-cap companies and has a global reach. This broad exposure helps to mitigate risk while still aiming for those sweet capital gains. Keep in mind though, that diversification doesn't mean it's immune to market downturns. One thing to be aware of is that AGTHX does come with a slightly higher expense ratio than some of the other funds we've talked about, but honestly, in the world of actively managed funds, it's really not that bad. And when you consider the potential returns, it might just be worth it. It's like investing in a premium cup of coffee. You're paying a bit more, but you're getting a richer, more flavorful experience. This fund is for those of you with a long-term mindset who aren't afraid to ride out some market volatility. Let's get down to brass tacks and look at some numbers. As of mentioned current date, AGTHX has a 5-year average annual return of mentioned current 5-year average annual return. That's right, you heard me correctly. Of course, past performance is never a guarantee of future results, but it does give you an idea of how this fund has performed historically. And frankly, it's a pretty impressive track record. But remember, every investment comes with risks. AGTHX is no different. It can be volatile in the short term, especially during market downturns. That's why it's crucial to do your due diligence. Consider your risk tolerance, and determine if AGTHX aligns with your overall investment goals. Don't just jump in headfirst because I said it's a good fund. Do your own research. So, the big question is AGTHX the right fund for you? Well, if you're looking for a long-term growth-oriented investment and you're not afraid of a little bit of risk, then AGTHX could be a solid addition to your portfolio. Remember, diversification is key. Don't put all your eggs in one basket, even if that basket is a seemingly awesome fund like AGTHX. Spread your investments around and you'll be in a much better position to weather any storms the market throws your way. AGTHX is like that reliable car you keep in your garage. It might not be the flashiest or most exciting ride, but it gets you where you need to go. And at the end of the day, that's what matters most, right? This is not financial advice, just me sharing my thoughts on a fund that I think has a lot of potential. As always, do your own research, talk to a financial advisor, and make the best decision for your unique financial situation. Alright folks, let's dive into another investment powerhouse, index funds. And when it comes to index funds, you can't go wrong with the Schwab S&P 500 Index Fund, SWPPX. This fund is like the Toyota Camry of the investing world. It's reliable, affordable, and it gets the job done. Now, I know what you're thinking. Graham, index funds? That sounds kind of boring. But trust me on this one. Index funds are a fantastic way to invest for both beginners and seasoned investors alike. They offer broad market exposure, low fees, and they're incredibly tax efficient. The Schwab S&P 500 Index Fund specifically tracks the S&P 500, which, as you might know, is an index of 500 of the largest publicly traded U.S. companies. This means that by investing in SWPPX, you're essentially investing in a tiny piece of all those companies. Talk about instant diversification. And the best part, this fund has an incredibly low expense ratio. In fact, it's one of the lowest in the industry. That means more of your money is working for you and less is going towards fees. It's a win-win situation. Let's take a closer look at what makes SWPX such a solid investment choice. First and foremost, it's managed passively, which means it aims to match the performance of the S&P 500, not beat it. This might sound counterintuitive, but hear me out. Actively managed funds often come with high fees and often fail to outperform the market in the long run. With SWPX, you're getting broad market exposure at a fraction of the cost. Another key benefit of SWPX is its tax efficiency. Because it's passively managed, there's less buying and selling within the fund, which translates to fewer taxable events for you. And who wants to pay more taxes than they have to, right? And let's not forget about the power of compound growth. Over time, even small gains can snowball into significant returns, thanks to the magic of compounding. Now, you might be wondering, is SWPPX the right fit for my portfolio? Well, if you're looking for a low-cost, set-it-and-forget-it investment that provides broad market exposure, then SWPPX is definitely worth considering. It's an excellent choice for long-term goals like retirement or saving for your kids' college education. But remember, diversification is key. Don't put all your eggs in one basket, even if that basket is a solid index fund like SWPPX. Consider adding other asset classes to your portfolio like bonds, real estate, or even a sprinkle of cryptocurrency to spread your risk. As always, I'm not a financial advisor, so this is not financial advice. Do your own research, talk to a professional, and make the best decision for your individual financial situation. That wraps up our rundown of some of the top-performing investment funds in the US. Whether you're a seasoned investor or just starting out, I hope this video has given you some valuable insights and inspiration for your investment journey. Thanks for watching. We hope you found this guide to investment funds in the USA helpful. Don't forget to like, subscribe, and hit the notification bell for more investment tips and strategies. Happy investing!